Good morning and welcome to Fast Market. It's Thursday, April 25th. I'm Alex Coffey and I'm joined on set by co-host of Fast Market, Kevin Hinks, and by Scott Bauer, CEO of Prosper Trading Academy. Scott, thanks for joining us. I think it's twice this week.
It is.
Good to see you again. We got a little bit of movement though, Kevin. You want to set this up for us?
And here's why we're getting movement, and here's why it's not real surprising. The foreign markets were mostly down overnight. A couple of the numbers, pretty big percentages. So that and 3M, it's not real surprising that this market is a little soft here. But in the next breath, I can say it's not really surprising that it's also starting to firm up here, and I think it'll close off those lows that we said, because we're getting a lot of good earnings and a lot of big companies putting up some nice numbers. 3M excluded from that, but besides that, it's a pretty good day for earnings.
Yep. Yeah, well, first off, Scott, I think it's very important to note where we're at in equity markets here in the U.S. We're not far off all-time highs. This is not much of a sell-off at all. But it is important to note domestically, at least, that, as Kevin mentions, 3M is overshadowing some pretty strong numbers out of Facebook and out of Microsoft, which just keeps on chugging higher.
And a stock like iRobot, just got to throw that out there too. But no, you're right. It's a big divergence in the market, because someone could look at the Dow and say, oh my God, we're down 200 points.
Right.
But if you exclude 3M out of that, it's a 50-point loss, because 3M's about 140, 150 points of that. So the broader market is not that under pressure. However, we are starting to see a little bit of this seep back in, because we're finally seeing VIX approach, maybe where we should be. That 12 handle that we traded at for so long, that we all talked about, time to buy insurance, time to buy insurance. Sure enough, we're up almost at 14.
Right. 1370 as we start the day here. That's pretty significantly off. Remember, we were talking about an 11 handle,
yes,
right before the long weekend. So the fact that it's almost a 14 is not insignificant.
Yeah, and your May VIX future closing in on 15 as well. You are seeing a little bit of a pullback in the bonds, not much, down 7 ticks. We saw some strength in the bond market yesterday that we thought was a little bit peculiar, given that the markets were fairly firm. We didn't get a lot of movement in terms of the equity markets, given where we were in terms of all-time highs too. You maybe would have expected to see a little bit of weakness in treasuries.
Yeah, I mean, right now it's the overall market, treasuries, commodities, and obviously equities. There's a bid behind everything, and things are pretty strong. But at some point, that's got to break. Some point, that correlation has to start falling apart.
So when you look at that, then, Scott, is it just still that same story of America, the U.S. being the best house on the block kind of a situation versus the rest of the world?
Not just best, I think it's the only house on the block.
How do you put a real bullish skew on bond futures that are down 7 ticks? Because frankly, with this durable goods number, they should be down more than this.
They should,
and
absolutely.
that is exactly goes to Scott's point. There's bids below this market on a bunch of these, because a 2.7 durable goods bond should be down in the teens or double digits.
I'm glad you mentioned that, because durable goods was a pretty impressive beat, expecting only 0.7%, seeing 2.7. That's a pretty big surprise to the upside on durable goods. But you did have that kind of, again, offset a little bit by a worse than expected jobless claims number coming in at 230 versus 209. And so I don't want to spend a ton of time on this eco data as it happened earlier this morning. I think the big story here is, again, you're getting mixed data, again, kind of threading that needle of more of Goldilocks picture.
I like this mixed data. I think that adds to some of the volatility that this market needs to shake out what's going on here, shake out this grind higher. And I'm not saying that that's a bad thing. We can go higher from here, but I don't think we can do it with the lack of volatility. And maybe these numbers that came out this morning are something that's going to set up a scenario where we start getting outside numbers, not those Goldilocks numbers that have really just kind of helped propel this market to where we are.
Alex, there's an old saying from the trading floor days, it's the leaper and the creeper, right? And the creeping market can go higher. The leaper will bring in lots of sellers and is destined to fail.
Well, and we get GDP tomorrow morning. I think this is a pretty important number, just given all of the inputs that have basically changed over the last couple months. I think this is going to be pretty well watched tomorrow morning when we get that number. But let's pivot to something that's a little bit more pertinent to our portfolio here. We had some earnings that came out, some big name companies yesterday afternoon. And Kevin, if you want to pull up Tesla, I think that's where we should start here. Is Tesla was interesting because they basically came out a little bit later than expected. We were waiting there.
Yeah, about 45 minutes later.
On the edge of our seats. And
you know, Elon wanted to upset the apple cart, do you?
Whenever when you have that, I was thinking, what are they going to say that is bad? Why are they delaying this? And it ended up being, not as big of an event. It was inside the expected move, from what I understand, if I remember correctly. And we came into this announcement already short 3 of the, I believe it's the 245, 240 put verticals, and we went ahead and made that a round 5 lot by selling 2 more at about $1 yesterday, Kevin.
We had profits already on the table, Scott, on a 3 lot that we sold on the 5th of April. Yep. The best trade we decided after a lot of discussion was to just add to some of that and make it an even 5 lot at a little higher volatility. But that was a lesson because we were already profitable. Even though we always talk about waiting till the last possible moment, we had some nice profits in a 3 lot spread already before that. So all we did yesterday is something we don't do very often. We had a position now, we added to it.
And so we kind of had this original trade idea from looking at the Tesla chart and seeing that 250 level seemed to be acting as a pretty solid support level. We went a little bit below that, gives ourselves a little bit of a room for it to bounce off that, and we established a position. And as Kevin said, we look at the option chain yesterday, right to the expected move, roughly maybe a little bit farther beyond was right where we're at. We felt we were positioned fairly well. And Kevin, I think we're looking at this one. We just got to take it off here.
Here's the thing. Exactly right. So all the things that we're saying about Tesla, and we put on the right trade and we did it the right way, take it off now. Whoa. Because be careful of Tesla's news, let's face it, was worse than anyone thought. Right?
Sure was.
They had some good news in terms of guidance. They held on to the number of cars for the year, but they've got some issues. They need to raise cash. Not saying that this may be the perfect place to buy Tesla, but this put spread right now from where we are has more risk than reward. It's time to get out.
And I would almost argue that we actually had the wrong trade on, as you're seeing Tesla down $7.50, but because it was inside the expected move and you see volatility coming out of the marketplace, we were able to still be profitable on this trade, even on the 2 that we put on yesterday.
Dead wrong, but profitable.
Dead wrong, but profitable. And Kevin, like you always say, move that inventory, right?
Time to go. I'd rather end this day coming into maybe some downgrades tomorrow and things like that, or they may break later on today with no position on and then retrade it.
Well, it's one day to go to. This is just risk. Yep. So let's move on to Facebook as well here. We did something a little bit different than we normally do. We kind of thought about it from a directional bias standpoint. We could make cases either way. And so we looked at it, it was a battle between strong numbers and the profits that Facebook shows and the concerns about the future of the company going forward. And so what we did, Kevin, is we actually went and we bought a double calendar spread right to the expected move. And so Facebook opened much higher, but it is right on our call strikes now.
Right, and we were actually down money earlier in the day because Tesla had gone way through our strike. Now it's come right back down to our strike. Again, the prudent thing to do, take it off right
Take the calls off, and I think that
take the calls off.
You could even consider buying in those shorts, but you could also leave that if you wanted to, buying in the short puts, that is, and leaving those long puts out there since they don't expire until the 3rd of May.
No, absolutely. I mean, that's, again, this is risk management at its finest. You take it off, you put a trade on for a reason, for this move, for this event, take it off, and you move on.
Yeah.
And so we were working a trade a little bit higher in the market. We'll go ahead and cancel that since we just filled it at a buck.
Remember,
21.
we were wrong on this early this morning. When this stock was up near $200, we were short the 192 strike. It's come right back to our 92. So if you imagine in your brain that peak on the calendar spread, we were to it and past it and came back to it.
And great minds think alike, because at Prosper, we did a similar type of trade.
Yeah.
We actually sold an iron condor yesterday.
Right.
With the upper strike being 192.5, 197.5. So again, this morning up at 200, not looking so great. Risk management came back in, we closed it out, and we're done.
Take your profits.
Yep.
And so, although we had Microsoft yesterday, we actually made the election to go into Chipotle Mexican Grill, as it's one that's a little bit more of a volatile move, makes it a little bit more interesting maybe from a trading standpoint. And so we did 2 separate trades that were complementary, Scott. We sold a call spread above the market. We've already taken that off
For I think 8 cents this morning, because
10 cents, 8 cents, somewhere around.
I put in a bid early this morning when the stock was, selling off. That we got it for under a dime.
And that, of course, was a profitable trade. You see a move down, and even when it opened unchanged, that was the move you were looking for when you're selling premium above the market. But we also did something below the market where we did one of Kevin's favorite trades of the unbalanced put butterflies, which is essentially, of course, selling, a larger amount of put verticals and then buying the one for a credit.
Yep.
This is actually the move we wanted for this for this particular trade. Even though it does have long deltas, it benefits from a move down towards those short strikes, Scott.
Absolutely, and like you said, you're getting the move right to the strike here. So now the question becomes, okay, you've got a day and a half in this trade. What do you do with it?
Right. And this is another one where we are profitable on this trade, but we've still got some fairly chunky premiums in some of these options. So, the theta number, if you look on the Analyze tab, the theta number's probably still there.
That's
Let's go to
Facebook.
Tesla.
No, it's CMG.
Yeah, sorry. And you can see the theta number is probably still there. Let's open up our slices. And you can see we still have some nice theta, but we have a lot of risk, and we're getting into that zone where things may be getting a little better here. So, we're at one of those things. I think you watch this heavily. Right. I think you take the risk off of the call side, which we already did. Eliminate that. Take your profits on that, and then watch this very carefully. By the end of the day, maybe you're out. If it looks like it may go into that zone. Remember, this is part of the reason why you put this on is because on expiration day, if it goes into this zone right here, you get the double whammy, right? You get the long put vertical and the short put vertical going to zero. So this could get a little interesting.
I think we should talk about this one for just a little bit longer because it is a little bit different, and because Chipotle coming out of earnings, you saw it opened unchanged roughly, and you saw how much it sold off once the market did open, and it has the I guess tendency to move significantly just because of its stock price. This really is a fair amount of risk, Kevin, going into tomorrow with 1 day to go. Would you fault someone if they were looking at an example trade like this, they weren't comfortable with the risk, and at least maybe reducing the size, maybe working to sell?
You've got a profit on both sides.
No, absolutely not.
So both sides of this trade have a profit, right? So you've already done half of it. You've already taken off half the trade. Now you have to understand the risk that you have in this trade, but how do you want to do it? Do you want to sell out the long put vertical and manage the short side? That could be something you do. If it gets in this range, look what you have in terms of the long put vertical, right? And that's
where
trading
I would
$1.17.
start as well. And I think maybe, I don't know if $1.17 is enough for me to really be interested in selling it here unless I wanted to take the whole trade off. But maybe you put in a working, offer here a little bit higher above
maybe
the market.
130, see if you get a drift lower.
And if you do get filled there, then maybe you look to take off maybe half of the short put vertical, so you leave some of it open to maybe collect a little bit more of that theta that's still in there, but you do reduce that overall exposure quite a bit.
There's an old saying, these are two spreads that we have on in relationship to each other. If you take one off, you don't have the same position on anymore.
That is
now
correct.
You're just short put verticals.
One other thing to throw into the mix here is if we bring up a stock chart here, you're going to see that 650 level, which was right at the sweet spot, right at that short strike there. Man, that's the 50-day moving average.
So let's go ahead and we can add that. So if you're following along, you can go to Studies, Add Study in the moving average, add Simple Moving Average, and then it's going to default to 9 days. But I'll go ahead and I'll right click and we'll make this a 50-day just so we can see that real quick here.
Pretty good on that, Alex.
Fast.
I have spent some time on this platform. It's right to it, as Scott says.
So that's also something for me to consider here. Now, you guys know me. I'm the most risk-averse guy in the world out here when it comes to this. But I'm looking at that, and I'm looking to where the stock traded down to this morning, consolidated, and now it's just kind of hovering. So we've got theta working for us right now. But like you said, Kevin, that doesn't mean close our eyes and walk away. That means stay on top of this and manage this.
Following that logic, though, theta would be working for us on the short put vertical side of this trade, but it would be working against us on that long put vertical side of this trade. So if you were confident in this simple moving average and you wanted to, change the position slightly and take advantage of it holding this level, you could look to sell out that long put
Absolutely
vertical, as
right.
we said, right here, and hold in that that potential
We've
theta
done that
loss.
many times on this show when it gets down to a level where we'd want to be managing a long position anyway, or trading it from the long side. You can sell out the long put vertical. Take your profits on that, and then all you're doing is managing a 4-lot put vertical short.
And so let's at least put in an order to sell that a little bit. It's already ticked up quite a bit since we even talked about it. It was about $1.10, now it's $1.40. Maybe we put it in at $1.50. 50 and see if we get filled, and we can go from there. But let's look at something that has earnings after the close today that I consider kind of a blue chip company, and that's Intel. But really, this is a stock that's been on an incredible run throughout the beginning of this year. It's up 23.5% year to date. It's a massive player in the chip space, and we're looking at a company that it's even rallied over the last week or so on news that you would have think maybe would have been bad. It's stepping out of the 5G space, kind of giving way to Qualcomm with Apple, but it allowed them to kind of focus on their more higher profit margin, which is their server and PC processing businesses. And so, Kevin, when you're looking at a company like this, you're getting a little bit of a move down this morning, but you're just off all-time highs.
Right.
When you're looking at something like this, where do you start in terms of generating an idea for a trade going into earnings?
Every earnings play that you're doing this quarter has to take into effect how far some of these stocks have run. And you have to be cognizant of, you're seeing a 2.4% sell-off pre-earnings, right? That being said, remember, there is some uncertainty here. Robert Swan, the CEO, this is his first earnings release, right? Maybe he's got a little room to make some overall changes and miss. I mean, the stock's up 25% for the year. Look at Chipotle. Chipotle's earnings were good, and the stock is down significantly. So, sometimes it's the move, it's where it is for on the year, and is someone going to take profits on anything other than a blockbuster number?
And Scott, I don't want to put words in your mouth, but I think you look at things similar to we do, and you start with volatility and expectations going into an announcement or an event. And we always start with the current IV percentile and this market maker move on the platform. Right now with Intel, we have a 44% current IV percentile, and we have about a $2.30 move going into this announcement. That gives us kind of the expectations on where will this stock possibly be tomorrow morning. Am I right?
No question about it. That's where you have to start on this, and then you start looking at some technicals. Is there technical support area around that move to the downside? Is there anything on the upside? And then you start forming your opinion. Kevin, you always say, every trade starts with an opinion, right? So you look at this. Personally, I think that the profit taking today is just people getting out ahead of earnings. I don't think that's any indication of what the earnings are going to be or the sentiment on the street. I personally don't. I look at this, and what I would look for is some sort of calendar, because implied volatility is not very expensive. At only 44% going, IV rank going into earnings, that's not very expensive.
And the one day, the tomorrow's expiration number is more than double the second, or almost very close to double what the second expiration is. So that's pretty good divergence there. The other thing is, I think what jumps out at me for a stock like Intel is $2.20 expected move. Seems a little on the low side.
Seems very cheap.
For everything that we have going on. Remember, and we had this discussion with JP Morgan just a couple weeks ago, that number right there, with everything going on in this economy and in this world, that number looks small to me.
I totally agree with that.
On the last earnings announcement, it actually gapped downwards post the announcement, but it's basically been straight up since then. It is up about 16.5% since that earnings announcement. But when we're looking at something like this, Kevin, I tend to agree with you that $2.30 seems low, considering it's moved $1.42 today. But this isn't a stock that tends to move a significant amount on earnings in particular. But when you do look at something with the 73% implied volatility with 1 day to go versus that about 40 for next week, I look at what Scott's saying, taking advantage of that differential. It's probably going to end up somewhere around the mid-20s after this news is out. The calendar market, if you were able to find the directional move, could be a potential example trade that we'd look at.
Exactly right. And this sets up perfectly for the calendar, because high volatility in relatively low premium names sets up for nice, inexpensive calendars, which you're not going to hit home run trading calendars, but you'll also have a nice high probability of being successful.
Absolutely. So if you look at this, you take into account that although it's sold off a little bit today, but it's just off all-time highs, do you look to the put side then if you're looking to lean a little bit bearish into this, or do you kind of go with the trend here, either one of you?
I'll step in. I like the upside call calendar.
There you go. Especially
Kevin,
since today. Now I've created a put spread.
You got the put calendar.
Really just to identify what I was talking about being, look how inexpensive.
And I'm going to go out to the same area, but on the upside. You're going 55, which is that market maker expected move to the downside. I'm looking at the 60 strike on the upside.
Okay, and then one thing that I would add into this conversation is, given where we are in the marketplace, given what expectations were set in terms of there were lower bars than they had been, it seems that what I've noticed so far is companies that are surprising on the miss have been being punished more so than they normally are, and they're moving more than the expected move. And then outside of Facebook, companies that have been beating expectations seems to have been inside the expected move. Do we take that into account at all when we're looking at generating a calendar spread in terms of finding out where that move is?
Well, that goes back to the discussion I was just having, which you have to look at how far these stocks have run, right? The beats are minimal on the upside, the misses are bigger on the downside. And some of the beats are on the downside, right? Yeah. Just look at Chipotle. And Scott, you're going to love the price that this 60 calendar is setting up. 12 and 11 cents. It's ticking back and forth. So really inexpensive way to play this.
I like it. And you do have to take into consideration what Alex said, that this volatility is going to get absolutely hammered, probably come down somewhere in the low 20% area or so, but that's okay. If we adjust that and we get a move to the upside, and it doesn't have to be right to 60, but if we get something to the upside, that calendar is gonna work out nicely. And whether you take a look at a call calendar or a put calendar, it is a less overall risky way to play a great directional move in a stock.
One thing to think about for something like Intel, it has not traded 60.
Nope, it has not.
I mean, that would be a new high that you're talking about.
And
there.
so do we maybe look to, is there, a 59.5, or is there a 59.5? It's a little bit below. It's roughly the same price. So you really can pick, any of these
12, 13,
strikes,
14
just
cents.
where do you think it's going to get to? Kevin, thoughts on this one, or do you want to move it back to the put side?
Well, I'm perfectly okay. Here's what. Remember how we just made money in Facebook. We had a double calendar on. And one of the calendars made all the money for both positions because it went right to our strike. Yep. So if we play this right, you can do both. You can, and especially at these low levels, think about it. If you do one of each, $30, $35 plus commissions, you can play both of these. It's a nice way to do it. And if you're right, like we were this morning in Facebook, it's a nice exponential winner.
And we can see up here on the top real quickly how that changes the risk profile slightly, as you'll have two peaks as opposed to just the one. This makes you a little bit more neutral, but you still need that move.
You still want that move.
You still need a move one way or the other. But we'll go ahead and we'll route 5 of those real quick. Scott's going to be joining us later on the show. We got to leave this block here. But coming up, we have our face-off segment, as we're going to dive into technicals with Michael Fairborn. We're going to be looking at Amazon, so stick right here on the TD Ameritrade Network. Fast Market, we'll be right back. Welcome back to Fast Market. I'm Alex Coffey, joined by Kevin Hinks and by Scott Bauer, the CEO of Prosper Trading Academy. Thanks for joining us again, Scott.
Absolutely great to be here.
We don't have a ton of time, so I just want to jump right into it. Let's talk about Starbucks. We just talked to Andy Swan from Likefolio. He was showing, after the incident they had in Philadelphia, their happiness amongst their customers has basically just rebounded back to where it was. And this is a story of a company that's really just executed really well over the last year and charting new highs, it seems like every day.
I look at that, and it was a really interesting conversation. But again, are we doing something for an investment or a trade here? Right? That's my question.
Right. We're traders.
Right. We're traders. So I'm going to look at something really for kind of a one-day move here. Or, maybe it's a calendar. Maybe the options I choose go out a little bit further. But really, I'm looking for a one-day move based on earnings here to see what happens.
Scott Bauer, do you play this from a perspective of it's up over $2 this week?
Well, I look at this and say, yeah, it's trading at all-time highs, but does that mean it can't go higher?
No, absolutely.
Right.
But here's my point, because we have some interesting aspects of this, but really what we're looking at here is, can this, because I know I don't drink coffee, but I trade Starbucks. And this stock, as you know, can really move on earnings day. You've seen a couple in the past, like right there. That was around the event that happened. That was when they guided lower for earnings. This is when the earnings came out. Obviously, a big beat on earnings there. That was a massive move in earnings, and it's gone straight up since then. The question is, do we look at Chipotle and look at something like Starbucks and say, how good do they have to be to have the stock go up?
There's no question you have to look at similar type of companies. However, Chipotle has also had its other issues with some of the food processing and this, that, and the other. So I think you really have to isolate it to Starbucks. And I'm not saying that we can make more new all-time highs. I'm just saying, don't look at the chart and say just because it's up there doesn't mean it can't go higher.
Well, and you got to look at things relatively too. We're talking fundamentals in terms of price to forward earnings. Starbucks is in line with its 5-year average. Chipotle was a little extended on that valuation calculation as well. So I think you need to take that into account. But let's just jump into generate an idea for a trade and where we start for that each and every time, as we mentioned in the first portion of the show, is that's market maker move and that's IV percentile. Right now you're at about a $2.90 expected move. On an IV percentile exactly at 50, that's right in the middle of where we've been.
No, and it's higher than what we saw in Intel. It's right in the middle, so volatility is kind of neither here nor there. So like Kevin said, and we said earlier, you just have to look at it and say, okay, I'm going to take a neutral play. I'm going to look for short. I'm going to look for a long, and then kind of construct it around that.
One of the problems with a stock like Starbucks is it doesn't give you big premiums in some of the options. Now, some of these I'm looking for a one-day move. Not bad, actually, in terms of if you go to the 75 strike, so 75, 74. I mean, that's right around the expected move. Actually, I'm sorry, I'm short. If you go to $74, it's only 50 cents.
Yeah.
Hard to find something, but that is an elevated PE or earnings move. So how do you? I think this screams of a calendar spread again. I mean, it just runs in because you just don't have the premiums in these to do anything all in on that first, on that front expiration.
Unless you play both sides, maybe.
Mm-hmm.
So if you look at that market maker move of just shy of $3, you're targeting, let's say 74 to the downside, 80 to the upside. Maybe there's an iron condor right around those strikes that gives us, let's say a $1 iron condor, maybe somewhere about 45 cents.
I actually like that you went there because that's what I was going to mention is because there's only one day to go, this is the opportunity to really sell this implied volatility on this one move. This is a true earnings play with one day to go. And you could even look to selling an iron fly in a way where you're almost doing the straddle in case you get basically just muted earnings and it kind of comes in unchanged, give you a chance to make a little bit more. But what Kevin has built out right here is exactly the trade structure you're looking for, getting about 1/3 the width of the strikes at 32 cents on a $1 wide iron condor. Actually on both sides outside the expected move, Kevin.
Right. I'm looking. If we do, what I want to do is I want to check and just run a test and see if we widen this out. Where are we in terms of 73, 72, and how much do we get there? 53 cents. Not bad for $2. Not as good of a return as the $1 spread, obviously, which is over 30 cents, so a little bit less there. But that's a way, if 30 cents, remember, on a four-sided trade is not enough to make it worth doing. Remember, there's $2, it's 53 cents, a little better.
And if you want to get a little bit more, and if we take into account what we talked about earlier in where companies that have been executing well but beating lower expectations, maybe they aren't getting that pop to the upside. You're potentially a little bit more comfortable in an example trade, taking additional risk to the upside as opposed to the downside. You could skew that with as well as we have up right here, $2 wide on the call side, only $1 wide in the put spread. But Kevin, when you're looking at something like this, do you almost go to what you had originally?
No, I mean, remember, if your opinion is that you have more risk on the downside than the upside, you can add premium to this trade by widening the strikes on the upside and correspondingly shortening the risk, lowering the risk on the downside. Now you've taken that downside risk, on a two-lot, $59 per spread, so $118.
Yeah, and if we set that to break even real quick, we're going to see that it gets us down to, let's see here. Looks like
73.59 on the
73.59, yep, and 80.40 on the upside. And so when we're looking at that is outside the expected move with one day to go.
That's what I like. And what I would look, and on the same kind of thesis that you were talking about, Alex, I would look at the 79.80 on the upside. So a little bit short of what that market maker move is. And then the 74.73 to the downside. Gives me a little bit more room to the upside, a little less room to the upside. And what that's going to do is actually bump up that credit I'm going to receive. So if we change that spread on the upside to 79.80, just make it $1. Okay, now I've got a $1 wide iron condor for over 40 cents.
Now you've done that. Now what Scott did there to add premium, he lowered the short strike price, right?
Exactly,
he increased the premium by using his opinion and lowering his short strike, keeping the same amount of risk as he had before. Now his risk is equidistant on both sides.
Yep.
Looking at this right now, I think what I'm looking at, Kevin, I want to get your input on this, is just I like giving myself that even number 80, as it kind of acts like a magnet potentially. It might be me just in my head thinking, overthinking this a little bit, but I like that exact 1/3 the width of the strikes, as that gives me that probability of success right around, that 66 to 70% range, and that's kind of what I look for whenever I'm trying to generate an idea on something like this.
Everyone remember, this is 4 sides. You're taking in 33 cents, so it's a little commission intensive. We always should mention that when we do something, especially in a $1 iron condor.
Very true. And Alex, there is something to be said for those big round numbers, like $80. The market does like big round numbers.
And so we're looking at this too, because there is 4 legs, the natural price is about 7 cents lower than the mid price. We're going to work this at the mid price. We'll send 5 of them, and if we get filled, we'll look to manage this in the morning, Kevin. There's not a ton of time, but if we quickly pull up Amazon, I just want to quickly set it up so we can try to get a trade in here if there's time. We're looking at IV percentile that's about 33 or so, expected move around 70. 2,000 seems to be a significant upside resistance, and if we're looking on the downside, Michael Fairborn from our Utah studio basically pointed out that the downside about $100 lower seems to be like a support level. So both those are going to be outside the expected move. Is this one just simply because of the stock price that you just got to pick a direction and do something as far as that, or what do you look to?
Well, you can look for the same thing type of setup as an iron condor here if you want to sell that premium, going out to that $2,000 number or down to that 1820-ish number, which there is some support down there. Personally, this is me personally, I think 2,000 is going to be a magnet in this thing unless they just have a catastrophic type of report. However, we should see what volatility is doing. We should see what the premium amounts are. And if we can construct an iron condor out to those points that you were talking about, Alex, that may be the right thing to do.
And so Kevin's pulling one up right now. It looks like you're getting about 50 cents on the call spread side. And so if we went a little bit lower, it looks like we're even up the tough part with something like Amazon, you just have to open up so many strikes. But if we looked about $70 lower.
About 1850?
Yeah, and especially if you wanted to skew it a little bit to the upside too, that's going to be right around that expected move. But when we look at that, you're getting about 65 cents there. So if we add back in that 2,000, 2.5.
It's not horrendous.
You're getting about a little bit over $1.
Yeah, I mean,
that's right around half the width of the strikes.
Yeah.
So this is a little bit lower probability of success. I can just tell that by the amount of premium we're collecting. But this is a one-day move as well. Similar risk profile if we pull this up on the Analyze tab here. But this gives us a chance, if we get a move inside the expected move off this report, to make $115 per spread potentially tomorrow morning.
One-day move, and the bottom line is it's completely risk-defined, so anybody that would look at this knows what their risk is, and if you like that it's going to stay within that market maker expected range, somewhere thereabouts, not a bad setup.
One kind of a public service announcement for those following along, and really just telling myself too, in terms of an example trade on Amazon. One, you trade it risk defined simply because its stock price is almost more like an index than an individual stock. But because it is expiration day tomorrow, these spreads, if you did get a piece of this near at the money, you're going to want to make sure you take this off so you don't have any assignment risk going into the weekend, as this stock can get very, very expensive very quickly in terms of a notional value.
No doubt.
But all right, guys, we got to leave it there. Scott Bauer, thanks for joining us as always. We'll look forward to the next time you're here. That does it for Fast Market today. Tune in tomorrow at 10 a.m. Central right here on the TD Ameritrade Network. Have a great day.